this session on good banking. And if I could just start by saying a few words about why NEF and Compass have organised this session at the conference today on good banking. Good Banking and the Good Banking Forum is a new project by the New Economics Foundation and Compass that we launched very recently. The reason for this is, as we all know, and I don't need to tell you in this room, we have a banking system that remains unreformed, despite the taxpayer bailout of £850 billion in this country alone. And we can see in the city that it is increasingly business as usual. And this week, the events in Greece are showing just how fragile the banking system remains and why it needs to be reformed. So we believe that the banking system must be fundamentally reformed, and key to that, or one of the keys to that, must be the proper separation of investment and retail banks. We need a new Glass-Steagall Act. And we do not believe that Vickers and Osborne have gone far enough. And so Compass and NEF are doing a number of things as part of the Good Banking project. Firstly, we held a very successful Good Banking Summit in May, which was attended by experts, academics, campaigners and others, to start to map out what a good banking system would look like. And this summit formally launched the Good Banking Forum. Secondly, as an outcome to that summit, we will be making a detailed submission with detailed proposals to Vickers, to the Independent Commission on Banking, and that's one of the outcomes of the summit. Thirdly, in the coming weeks, we will also launch a public good banking campaign and a good banking forum website. And we will use this to put pressure on Vickers and the government over the summer in the run-up to the commissioning report, the Commission reporting, to really put pressure on the government and on Vickers to go further in their reforms, ensure that we have a safe and secure banking system. So that's a bit of a background to why we've organised this session today. And if you would like to be involved in the Good Banking Forum, then please do get in touch with myself, and I will make sure that you get put in contact with the right people so that you can be fully involved in the Good Banking Forum. So, to kick things off, we've got three very excellent speakers with us today. The first is Lydia Prieg, is that correct? Sorry. Lydia is a researcher for NEF's finance and business team. She came to NEF from Oxford and the trading floor of Goldman Sachs, nonetheless. She has been using her knowledge gained on the inside to inform proposals for regulation of finance, nationally and internationally, that would put finance in its place as servant, not master of the economy. Second, we have Mel Evans. Mel has been part of the environment and social justice activist group Platform since July 2008. And Platform uses research, campaigning, and activism to make change happen. And Mel has been part of the team that took the Treasury to court for their failure to apply their own investment rules to investments made by the new public Royal Bank of Scotland. And finally, we're joined by Catherine Howarth, and Catherine is Chief Executive of the investment charity Fair Pensions, and Fair Pensions works to make sure that people are aware of their power as economic and not just political citizens. And Fair Pensions has campaigns for greater transparency, in particular with regards to the tar sands project by BP and Shell. And Catherine also, before working at Fair Pensions, also worked at London Citizens as an organiser. So I will hand over to Lydia to kick things off.
Thank you. Can everybody hear me? Okay? Yeah? Okay. So obviously I've been asked to sort of generally talk about what's wrong with our banking system and what a better banking system would look like. Now, of course, I could potentially talk about an infinite number of things under that heading. So I'm instead, given that I've only got about 5 minutes, going to concentrate on picking up on what Gavin was talking about specifically the Vickers Commission, detail what they're proposing so far, why we don't think this is satisfactory at all, and why then we're taking this action to step up the pressure on them. Now, I'm sure you're all familiar with the Independent Commission on Banking. It was set up in June last year. It gave its first interim report in April, and it's given its final report in September. It was given the dual mandate of looking at competition in UK banking, but also stability. And by stability, they essentially mean tackling the too big to fail problem. Now, I'm sure we're all only too familiar with the too big to fail problem, so I'm not going to waste lots of time explaining what that is. I'm more going to concentrate on making sure that we're all clear on what all the ramifications of this distortion is. We're all sort of familiar with the classic moral hazard arguments that are put forward in all the newspapers. The idea that when you have privatized gains and socialized losses, the market isn't going to be a disciplining force, and instead all the market players are going to be incentivized to take far more risks than what they would do in a true free market. So that's kind of the argument that I'm sure you're all familiar with. An argument that some of you may be less familiar with is the fact that the too big to fail problem actually leads to something called the too big to fail subsidy. Now, what I mean by this is because there's an open understanding in the market that the government will step in and bail out any troubled bank, it means the banks can go out to the market and borrow from investors at lower rates of interest than they would do if they actually operated in a classic free market. So the reason why this can be thought of as a subsidy is instead of going out and paying very high levels of interest to borrow money, which would accurately reflect the riskiness of these institutions, they can instead go out and borrow at very low interest rates because they're effectively government guaranteed. So this does a couple of things. Firstly, it unfairly inflates their profits, and I say very unfairly because this is something that is specific to the banking industry. It's not something that's enjoyed by other sectors, even very large sectors like aerospace and defense. So it unfairly inflates their profits, but it's also very anti-competitive because it means that smaller institutions, like, for example, small building societies, they may receive a very small too-big-to-fail subsidy themselves, or they may receive no subsidy at all. And this means that their costs of funding are much higher, and it's much more difficult for them to compete with these larger institutions and offer the same products at a competitive price. More to the point, it can actually act as a barrier to new banks trying to enter the market at all, because obviously new institutions are likely to be smaller in scale, and they might see that these large institutions have these too big to fail subsidies, know that they can't compete, and thus not even enter the fray at all. So it's hugely anti-competitive. To give you an idea of just how big this subsidy is, Andrew Haldane, who's the Executive Director of Financial Stability at the Bank of England. Back in 2010, he released a paper where he tried to estimate how much this subsidy was worth to banks. So he did estimates for 2007, 2008, 2009, and the average over the 3 years for the big 5 banks, so Barclays, RBS, Lloyds, HSBC, and Nationwide, was between 50 and 60 billion pounds per year, which is, I mean, absolutely extraordinary sums of money. To put that into context, that's actually larger than most government department budgets, excluding obviously the very large departments like health and education. So this really is a phenomenal sum of money. I mean, when I'm comparing it to government departments, I don't want to give the impression that it's literally a case of the taxpayer writing a check and giving it to the banks, because it's not in a sense a subsidy, a transfer of money from the taxpayer to the banks, but rather that the banks are able to borrow from investors at lower interest rates. So it is important because that you understand that it's not a transfer from the taxpayer, because that's the classic kind of response by the banks. They're like, oh, well, you shouldn't call this a subsidy because we're not actually taking money off the taxpayer. Well, while they're not actually taking 50 to 60 billion pounds off the taxpayer, it's completely incorrect to say that they're not taking anything off the taxpayer, because obviously the risk that's associated with banking is then being transferred onto the state. So it's going to push up the costs of government borrowing. So it unfairly inflates their profits, causes moral hazard, it gives them a huge commercial advantage, and it's pushing up the costs of government borrowing. So clearly this is a situation that should not be allowed to continue. Now, thankfully, most people agree with that, including the Commission. But the problem is that they view, as I'm sure you've all read, something called ring fencing as being the solution to this problem. Now, just so everyone's clear on what ring fencing actually means, at the moment, we're in a situation where if you had a universal bank, so a bank that does both retail and investment banking, the two subsidiaries can cross-subsidize each other freely, currently. Now, what ring fencing would do would be to put up a firewall around the retail section and say, you can continue to cross-subsidize, but only to a certain level, and a certain amount of capital has to be kept in the retail bank. So it essentially means that the investment bank can't ever run the retail bank completely into the ground. So it does that, but there are two major problems with ring fencing. Firstly, it doesn't get rid of the too big to fail problem. The reason why the Commission thinks it does is because they have this idea that if you begin to sort of go towards compartmentalizing the different parts of the bank, then if a bank goes bust, it'll be easier to sell it off in an orderly fashion to other investors and sort of wind down the bank in an orderly manner. I think a lot of people are very, very skeptical of whether that's actually possible. I mean, some of these institutions are so large you can question whether even in a perfectly calm market situation they could ever be sort of orderly wound down like that. But more to the point, in the middle of an already difficult financial crisis, or if multiple large institutions fail simultaneously, the scenario just becomes more and more far-fetched. So, I mean, I would sort of completely reject the idea of ring fencing and resolution mechanisms, which is what they're called, as being a solution to the too big to fail problem. But the point is, even if you think it does go some part of the way, even if you're only mildly skeptical about how ludicrous a proposition is, the point is that whilst the potential for government intervention lingers, whilst there's this question of, well, if the resolution mechanism fails, the government will step in, you're still going to have the too big to fail subsidy, and you're still going to have these banks borrowing at interest rates that aren't what they should be according to the free market. So that's problem number one. And then problem number two is, even if you had a very small universal bank, so the too big to fail problem wasn't an issue, because we have the government's deposit guarantee scheme, so in other words, all your savings are guaranteed up to a certain level, retail banking is implicitly subsidized by the government. Now, you could say that's fine because retail banking we sort of look at as a utility. That's something that the state should be partially underwriting. But of course, whilst you can still have the transfer of funds between retail and investment banking, the flip side of that is it means that the deposit guarantee scheme is also implicitly underwriting investment banking activities, which it should not be the duty of the state to do. So retail banking is, so ring fencing is just very much a sort of a diversion tactic to look like they're doing something, but not actually really changing or tackling the fundamental problems. I mean, I'm conscious I'm running out of time, so I'm not going to delve into details with my other problems with the Commission, just to give you a flavour.